Today we're going to dive into the mind of one of the most iconic and successful investors of all time, Warren Buffett. His name is synonymous with financial success, and his strategies have been the subject of study for decades. But what really makes Buffett so special? What are the secrets that have led him to become one of the richest men in the world? If you've ever wondered how someone can build a fortune of such magnitude and maintain it for so long, you've come to the right place. Today, we're going to reveal the keys behind Warren Buffett's success in investing, exploring his principles, philosophy, and lessons we can apply to our own financial lives. From his focus on intrinsic value to his unwavering patience, we'll understand how Buffett has built his empire and how you, too, can benefit from his teachings. So, if you're ready to learn from one of the best, let's get started. Warren Buffett was born on August 30th, 1930, in Omaha, Nebraska. From a young age, he demonstrated a natural talent for business and investing. At age 11, he made his first investment in stocks, purchasing 3 shares of City Service Preferred at $38 each. This early experience appears to have taught him a valuable lesson about patience, as he sold the stock prematurely for $40, only to see it rise to over $200 shortly after. This episode marked the beginning of his journey toward understanding markets and the importance of keeping a long-term view. One thing to keep in mind is that Buffett was influenced by his father, a stockbroker and congressman, and later by Benjamin Graham, whom he met while studying at Columbia University. Over the years, Graham, known as the father of value investing, became Buffett's mentor and instilled in him fundamental principles that would be the foundation of his success. 1. Warren Buffett's investment philosophy. You could say that Warren Buffett's investment philosophy can be summed up in one word: value. This means that unlike many investors who seek quick profits, Buffett focuses on the intrinsic value of a company. Value investing. So the first principle of Buffett's philosophy is value investing. Now, what does this mean exactly? Value investing, as Buffett does, is finding stocks that are cheap in the market but have great potential for long-term growth. Basically, it's like buying something that you know is worth a lot more than what you're being charged. Buffett has perfected this technique by looking for companies that have what he calls economic moats, advantages that protect them from competition, such as a strong brand, unique technology, or lower cost than rivals. For example, one of his most famous plays was Coca-Cola. Several decades ago, Buffett realized that Coca-Cola had a huge moat thanks to its globally recognized brand and massive distribution network. So he bought shares when they were cheap and has held them for years, making huge profits. Understanding the business. Another of Buffett's important principles is that he only invests in what he understands. If something seems complicated, such as advanced technology, he simply avoids it. Why? Because he knows that not understanding a sector well increases the risk of making mistakes. This has led him to focus on industries he knows intimately, such as insurance, consumer products, and energy, where he has a lot of experience. A good example of this is how Buffett avoided technology for a long time, until he decided to invest in Apple. At first, he was uncomfortable with the sector, but as he began to understand the business better and saw that Apple was not just a device manufacturer, but a company with a very strong ecosystem, he was encouraged to invest. As we will see later, this turned out to be one of Buffett's best investments. Patience and discipline. Buffett is known for his patience, another important point of his philosophy. He doesn't get carried away by market fluctuations or fads. His approach is buy and hold, which means he doesn't sell his stocks often. This is because he is confident that over the long term, the stocks of solid companies will increase in value. During the 2008 financial crisis, while many were panicking, Buffett continued to invest in companies he considered strong, such as Goldman Sachs. He knew that the market would recover and that these companies would survive, which allowed him to make significant profits years later. 2. Warren Buffett's management principles. In addition to his investment philosophy, Warren Buffett is also known for his unique management style, both in his businesses and in his personal life. These principles have not only contributed to his success in investing, but have also shaped the corporate culture of his conglomerate, Berkshire Hathaway. Delegation and trust in your employees. Buffett is a firm believer in delegating and trusting the people he hires. Instead of being on top of every detail, He makes sure to surround himself with talented people and gives them freedom to make decisions. He doesn't get involved in the day-to-day management of the CEOs of the companies he owns, but gives them autonomy to do their jobs. Buffett trusts the judgment of his employees and only intervenes if it is really necessary. A clear example of this is how he runs Berkshire Hathaway, a holding company that controls dozens of companies. Buffett lets the CEOs of these companies run the day-to-day operations, trusting that their decisions will benefit both the company and shareholders. Simplicity. Another of his strengths is simplicity. Despite being one of the richest men in the world, he leads a frugal life. He lives in the same house in Omaha that he bought in 1958 and does not indulge in unnecessary luxuries. This approach is also applied to his way of managing business, where he always tries to keep things simple and efficient. For example, Buffett doesn't spend money on expensive consultants or big advertising campaigns for Berkshire Hathaway. Instead, he prefers to let the success of companies speak for itself through their performance. Long-term thinking. Buffett always plays the long game. He doesn't worry about what happens in the next quarter or the ups and downs of the market. His focus is on sustainable growth over time, both in his investments and in the management of his companies. A clear example of this management style are his investments in Coca-Cola and American Express, which he has held for decades. He does not get carried away by fads or short-term market movements. His goal is to see these companies grow and prosper over time. If you find this video interesting, remember to give it a like and subscribe to the channel so you don't miss the next content. Let's continue. 3. Warren Buffett's lessons for investors. Over the years, Warren Buffett has shared valuable lessons that are essential for anyone interested in investing. Below, we'll explore some of the most important ones to understand his approach and apply them to our own financial strategy. Importance of diversification. For some, this is the most important lesson Buffett has ever given, since diversification is something of a protection against ignorance. Although he himself does not diversify excessively because he invests in what he knows deeply, for most investors, having a diversified portfolio is a smart strategy to reduce risk. So, if you don't have the time or expertise to research each stock thoroughly, diversifying across multiple sectors and asset classes can be a good way to protect your portfolio. Invest in yourself. Another great lesson from Buffett, which he has repeated many times, is that the best investment anyone can make is to invest in themselves. This includes education, skills, and health. Continually improving and acquiring new skills will increase your earning potential and allow you to make better financial decisions. Investing in education and personal development will not only help you increase your income, but will also allow you to make more informed investment decisions and thus achieve your financial goals. Staying out of debt. Warren Buffett has been very clear about his aversion to debt. He has always advised people to live below their means and avoid excessive use of credit. According to Buffett, debt can become a burden that limits your ability to invest and grow financially. When you are in debt, a large part of your income goes towards paying interest and fees, which reduces your financial flexibility and your ability to take advantage of investment opportunities. In addition, excessive use of credit can lead to a debt cycle that is difficult to break, where payments pile up and it becomes increasingly difficult to maintain good financial health. A life with no or minimal debt will give you the freedom and peace of mind to make wiser financial decisions and take advantage of long-term opportunities. Be emotionally stable. This is probably the best advice Buffett has ever given. One of the biggest challenges in investing is controlling emotions, such as fear and greed, which can lead to irrational and costly decisions. Buffett has always demonstrated a calm and rational attitude, even during the most dramatic market declines. The key to success in investing is to keep a cool head and not get carried away by panic or overenthusiasm. The market can be unpredictable and emotions can often cloud judgment and lead to rash decisions. Here are Warren Buffett's best investments. Throughout his career in the markets, Warren Buffett has made some legendary investments that have generated huge returns. Here we will review some of the most notable ones, which have not only contributed to his fortune, but have also served as perfect examples of his investment approach and philosophy. Coca-Cola. As we mentioned earlier, Buffett's investment in Coca-Cola is one of the most iconic of his career. In 1988, Berkshire Hathaway began buying Coca-Cola shares for a total value of $1.3 billion. Today, that investment has grown to over $20 billion. Buffett saw the potential in Coca-Cola due to key factors such as the strength of its global brand, an unmatched distribution network, and an impressive ability to generate consistent cash flow. Buffett identified these elements as the pillars that would sustain a successful long-term investment. The Coca-Cola brand is not only known worldwide, but it also has a deep hold in the minds of consumers, ensuring continued demand. American Express. Another big win for Buffett was his investment in American Express during the oil scandal crisis of the 1960s. At the time, the company was in deep trouble due to a scandal involving an inventory of oil that turned out to be much less valuable than previously thought. While many investors fled in terror from the crisis, Buffett saw a unique opportunity. He recognized that despite the temporary problems, the American Express brand and its loyal customer base had an intrinsic value that outweighed the difficulties of the time. In other words, Buffett understood that the real value of the company was not in the scandal itself, but in its solid reputation and the trust it had built with its customers. So he decided to invest heavily in American Express, a decision that has proven to be extremely successful. Over time, the company weathered the crisis and Buffett saw huge returns on his investment. This victory is a clear example of how Buffett seizes opportunities in times of crisis and how his ability to identify the true value of a company has led to huge returns. Geico. This is a classic example of Buffett using his deep knowledge to spot opportunities. In 1951, while still a student at Columbia University, Buffett discovered Geico through his professor Benjamin Graham, who was on the company's board of directors. Buffett was impressed with Geico's direct-to-consumer business model and low operating costs. Warren Buffett made his first investment in Geico in 1976. Over the years, Buffett increased his stake, and in 1996, he acquired full control of Geico for approximately $2.3 billion. As for Geico's current value, the company is considered the second largest auto insurer in the United States, contributing significantly to Berkshire Hathaway's revenue. This case also demonstrates Buffett's success in identifying companies with solid and efficient business models. Apple. Buffett decided to invest in Apple in 2016, when Berkshire Hathaway bought about 9 million shares, a move that has turned out to be one of the most lucrative of his recent career. Buffett was initially averse to technology investments because of how quickly the sector changes, but his perspective changed as he better understood Apple's true value. Buffett recognized that Apple was not just a technology company, but a consumer brand with an extremely loyal customer base. He saw that Apple's ecosystem of products and services generated recurring revenue, which was financially very attractive. The combination of consumer loyalty and the company's ability to offer products and services that remained in demand struck him as a solid investment opportunity. Over the years, Buffett has increased his stake in Apple, making it Berkshire Hathaway's largest investment today with a 30% stake in the portfolio worth more than $84 billion. As we've seen, Warren Buffett has built a legacy that goes far beyond his impressive fortune. His focus on courage, patience, simplicity, and integrity has inspired millions of people around the world. The secrets behind his success are not magic formulas, but rather solid principles that we can all apply in our own lives. Whether you're looking to improve your investing skills or simply want to lead a more dignified life, Buffett's lessons are a reminder that sustainable success is built on a foundation of solid values, informed decisions, and a constant commitment to learning. Did you know any of these secrets of Warren Buffett? Do you plan to apply any of them? Leave us your answer in the comments box. If you enjoyed today's video, don't forget to give it a thumbs up and subscribe to our channel for more financial content. See you in the next video.